Welcome to Finance Decoded. In this video, you will learn about the different types of ISAs, including how the accounts work, what are the tax implications, whether your money is protected, and finally, what are the pros and cons. This video is part 1 of the Ultimate Guide to UK Savings Accounts series, where we will cover the following savings accounts. Click on the timestamps in the description box below to skip directly to the ISA of your choosing, and click on the link above to watch the rest of the series where the other accounts are explained. Subscribe to be notified when the Ultimate Guide to Children's Savings Accounts premieres. So, the Individual Savings Account, also known as the ISA. The ISA is a tax-free savings account, and there are currently 4 types available: cash, stocks and shares, lifetime, and innovative finance. We will also cover the Help to Buy ISA, which is no longer available to open. To open an ISA, you must be a UK resident or a Crown servant, and each ISA has its own age requirements. For the 2020-2021 tax year, the ISA allowance is £20,000. Note, tax years run from the 6th of April to the 5th of April the following year. You can split your allowance across the 4 ISAs or contribute to just one. The decision is up to you. Let's look at an example allocation. £8,000 is added to the Stocks and Shares ISA, £2,000 is added to the Cash ISA, £1,000 is added to the Innovative Finance ISA, and £4,000 is added to the Lifetime ISA. You can open these ISAs with different providers. So your Stocks and Shares ISA may be with Trading 212, but your Lifetime ISA is with Barclays. In this example, we have used £15,000 of the £20,000 allowance. Therefore, there is £5,000 of the allowance remaining. There are 3 important conditions to remember. Firstly, your unused allowance cannot be rolled into the next financial year. So with the example, if the remaining £5,000 is not used by the end of the tax year, it's gone and will not be added to next year's allowance. Secondly, multiple ISAs are allowed, but you can only pay into one of each type of ISA each tax year. So if you opened a Cash ISA 2 years ago, another last year, and one this year, you are only allowed to pay into one of these Cash ISAs this tax year. And lastly, if you withdraw from your ISAs, the withdrawn amount will not be added back to your unused allowance, unless you are withdrawing from a flexible ISA. So with the example, if £2,000 is withdrawn from a non-flexible ISA, the amount that can still be paid into your ISAs is the £5,000 unused allowance. However, if the ISA is flexible, the withdrawn amount can also be added back to the flexible ISA or paid into another ISA type. Cash ISAs, Innovative Finance ISAs, and Cash in Stocks and Shares ISAs can be flexible. Lifetime ISAs, Help to Buy ISAs, and non-cash elements in Stocks and Shares ISAs cannot be flexible. So before we look into each individual ISA type, let's run through the 2020-2021 annual allowances and the tax implications when your savings are not in an ISA. The personal savings allowance is the amount of tax-free savings income you can earn each year and is based on your tax band. Any interest received above your allowance will be taxed. So, if you're a basic rate taxpayer, your allowance is £1,000. Higher rate taxpayers have a £500 allowance, and additional rate taxpayers do not have an allowance and so must pay tax on all interest earned. The next allowance is the dividend allowance. This allows all taxpayers to earn £2,000 of dividends tax-free. Any dividends earned above this amount will be taxed. Income tax on dividends is lower and the rate is determined by your tax band and is as follows. And the last allowance we'll look at is the annual exempt amount. With this, you are entitled to £12,300 tax-free capital gains. Capital gains above this amount will be taxed and the rate is determined by your tax band. Note, annual allowances are reviewed each year, and so next year these allowances may decrease, increase or stay the same. So how does a Cash ISA work? Well, to open a Cash ISA you must be 16 years old or above. You deposit cash and each tax year you can pay in the entire £20,000 ISA allowance or split the allowance with your other ISAs. There are different types of Cash ISAs available, such as fixed rate and easy access. The benefit of keeping your cash in a cash ISA is that no tax is paid on the interest earned. Additionally, your money is protected by the Financial Services Compensation Scheme up to £85,000. So if the bank which holds your ISA goes bust, you will get your money back up to £85,000. The cash ISA is best suited for those whose interest would be taxed, such as additional rate taxpayers who do not have a personal savings allowance or those who've used up their personal savings allowance. As the majority of people will not earn more than £1,000 in interest, the benefit of a cash ISA compared to a general savings account is minimal. The main disadvantage of a cash ISA, along with most savings accounts, is inflation. Interest rates for cash ISAs are currently around 1%, and the UK inflation rate is closer to 2%. Therefore, keeping your money in a cash ISA will result in your money losing value over time. To learn more about inflation, click the link above. To open a stocks and shares ISA, you must be 18 years old or above. With this ISA, you can invest your money in stocks, commodities, bonds, funds, and you can also deposit cash. Like the cash ISA, each tax year you can pay in the entire £20,000 ISA allowance or split the allowance with your other ISAs. You can decide where to invest your money by using platforms like Freetrade or leave it to the professionals such as Hargreaves Lansdown. The tax benefits of a stocks and shares ISA are significant. No tax is paid on interest, capital gains, or dividends. Let's look at a real-life example to demonstrate the benefit of not having to pay any capital gains tax. Two friends decide to buy Amazon shares. Sam buys his shares outside an ISA, whilst Jenny buys her shares via her stocks and shares ISA. On the 24th of February 2012, they each bought 10 Amazon shares for £112.66 each, and so spent £1,126.60 in total. Both Sam and Jenny decided to sell their 10 shares on the 2nd of September 2020 for £26,289.60. Both Sam and Jenny made a profit or capital gain of £25,163. However, as Sam did not buy his shares through an ISA and the gain is above the annual exempt amount, he must pay capital gains tax. Capital gains tax is paid on the profit remaining after subtracting the annual exempt amount. This is £12,863. Note, I've added the calculations to explain the numbers in this example. If Sam is a basic rate taxpayer, he will pay £1,286.30 in taxes. And if Sam is a higher or additional rate taxpayer, he will pay £2,572.60. So Jenny has saved and she hasn't had to pay tax and also has her full annual exempt amount allowance remaining, while Sam has paid tax and used his full allowance. Now, back to the stocks and shares ISA overview. With the stocks and shares ISA, you are protected by the Financial Services Compensation Scheme up to £85,000. This scheme covers you if your ISA provider goes bust, but not if the value of your investments decrease. The benefits of a stocks and shares ISA include generally higher returns, flexibility to choose a range of investment products, and the ability to transfer your ISA between providers, which is useful if you're not happy with your current provider's performance or charges. The stocks and shares ISA is best suited for a medium to long-term investor. Although this ISA has many great benefits, it's important to remember that the value of your investments may decrease, and so you may lose money. Also, income received such as dividends may also decrease over time. Additionally, charges and fees can build up, so make sure to compare providers. And lastly, stocks and shares held outside your ISAs cannot be transferred in. To open a lifetime ISA, you must be between 18 to 39 years old. You can use a lifetime ISA to buy your first home or save for later life. You can hold cash or stocks and shares in your lifetime ISA or have a combination of both. Each tax year, you can deposit a maximum of £4,000. This could be in 1 month or throughout the year. And you can continue contributing to the ISA until you are 50. The government will add a 25% bonus to your savings each month, up to a maximum of £1,000 per year. Note, this is based on the amount you deposit. Once you're 50, the government bonus stops, but you will continue to earn interest and investment returns. Remember, although you can have multiple ISAs open, you can only pay into one each tax year, and you can only receive a 25% bonus on one of them. Please note that while you can contribute to both a Help to Buy ISA and a Lifetime ISA, you can only claim the first-time buyer bonus from one. But you can transfer your money from your Help to Buy ISA to your LISA and vice versa. To withdraw money from your ISA without penalties, you have 3 options. Option 1, you withdraw to buy your first home. To do this, your LISA must be open for at least 1 year. You must be a first-time buyer and buy your home with a mortgage. This should also be a home you plan to live in and not to rent out or use as a holiday home. And your property must cost £450,000 or less. Option 2 is to withdraw at 60 years old or later. Lastly, you can withdraw if you are terminally ill with less than 12 months to live. The LISA is best suited for first-time buyers or those saving for retirement. The benefits of a LISA include the 25% government bonus, which you can use towards your exchange deposit or withdraw at 60 for your retirement. And unlike your pension, the withdrawn amount is not taxed. An additional benefit is that no tax is paid on the interest, dividends, or capital gains. Another benefit is that if you are buying with a partner and they also qualify for the LISA, you can both use your LISAs to buy a property together. However, there are disadvantages. You'll pay a withdrawal charge if you withdraw from your LISA for any other reason than the 3 options mentioned earlier. The current charge is 20%, but this will increase to 25% next year on the 6th of April 2021. Also, if you're using it for retirement, unlike your pension, your employer won't be able to match your contributions. Additionally, the LISA may affect any means-tested benefits you currently qualify for, as LISA funds are treated as savings. With the LISA, you are protected by the Financial Services Compensation Scheme. So let's move on to the Help to Buy ISA. The minimum age to open this ISA was 16 years old. Since the 30th of November 2019, this ISA is no longer available to open, but let's explain how it works. You deposit cash, and in the month you open the ISA, you can save up to £1,200. After this, you can only save a maximum of £200 per month. The government will add a 25% bonus, but you need to have saved at least £1,600 to be eligible, and this will give you a bonus of £400. The maximum bonus paid is £3,000, so to achieve this, you will need to have deposited £12,000. You are only entitled to the bonus if you are a first-time buyer and you are buying a house worth up to £450,000 in London or £250,000 outside London. You must claim your bonus by the 1st of December 2030. So if you won't buy by 2030 or you won't be buying in the next year, then it's best to transfer to a LISA, which allows you to save more money per year, and the bonus is not capped at £3,000. Your money is protected by the Financial Services Compensation Scheme up to £85,000. Additional benefits of the Help to Buy ISA include the 25% government bonus, which you can use towards your completion deposit. Also, unlike the LISA, you do not have to wait a year to be eligible to claim the bonus, and you are not penalised for withdrawing money. Another benefit is that if you are buying with a partner, you can both use your Help to Buy ISAs to buy together. But there are disadvantages with this ISA, such as the £200 per month deposit limit and the bonus is capped. The Help to Buy ISA also counts as using up your cash ISA option, so you can't deposit in your Help to Buy ISA and your cash ISA in the same tax year. Also, the bonus cannot be used towards your exchange deposit or indirect costs associated with buying your home, such as solicitors or estate agent fees. The final ISA is the Innovative Finance ISA. To open this ISA, you must be 18 years old or above. Through this ISA, you can invest in peer-to-peer loans, crowdfunding debentures, and cash investments. Each tax year, you can pay the entire £20,000 ISA allowance or split the allowance with your other ISAs. You are essentially lending your money to individuals and businesses over a specified period of time, such as 5 years, and you will receive a fixed amount of interest over this set period. The tax benefit of this ISA is no tax is paid on interest received. receipt. However, unlike the other ISAs, with the Innovative Finance ISA, your money is not protected by the Financial Services Compensation Scheme. So, if a provider goes bust, like Lendy did last year, you may lose all your money. The benefits of this ISA are the higher interest rates, usually at least 4% and some are over 10%, which is much higher than a general savings account, and prevents your money losing value due to inflation. This ISA is best suited for a medium to long-term investor. Now, there are several disadvantages to be aware of. You could lose your money if the borrower's default or your ISA provider goes bust. The interest rates advertised are not guaranteed and will be less if your loan is not repaid or is repaid early. Also, your money may not be lent straight away, and during this time, you will not earn any interest. Additionally, withdrawals tend to take time, so if you need easy access to your money, this is not the best option. And lastly, peer-to-peer loans and crowdfunding debentures held outside the ISA cannot be transferred in. So, that's ISAs explained. Stay tuned for part 2 of the ultimate guide to savings accounts. Thanks for watching Finance Decoded. If you enjoyed, then give the video a like. Want more? Subscribe below. Thoughts? Comment below and leave suggestions of videos you want to see next. See you in the next video.